Okay, thank you so much. Okay, I think we can start. Thank you so much for coming for this session. My name is Nguwi, and I will be taking you through this session on introduction to workforce analytics. It's an introduction. It's not a comprehensive discussion on workforce analytics. So where we need to, if there are any areas that we are going to cover and we need more information, we can then work on that in terms of the presentation. So for a lot of people, workforce analytics is new, but it has been there for a while now. And we hope that what we are going to share with you would be of some benefit to all of us as we go through this. And in simple terms, workforce analytics, we are looking at using workforce data in order to inform business decisions. There's a lot of information that is sitting in HR. There's a lot of information that is sitting in our systems, in human resources, either in an information system or somewhere else, even in hard copies. That information could then be used to make important business decisions. And as you will see from the examples that I'm going to share with you as we go through this particular session, that's key to take note of that. So workforce analytics, others prefer to call it people analytics, but it's the same. We are talking about using workforce information or employee information to inform business decisions. So why is the interest now in terms of this particular area? Why was it not there before? I think it's an evolution that also happens in any field where people start looking at how best to transform human resources in terms of business impact. And there has been discussions around this issue for a very long time where people were asking themselves, are we doing enough in terms of making sure that people get access to HR information that they can use for business decisions? All these are issues that we need to look at. So the interest has been cultivated largely because people want to get to check if HR practices have got any impact on the organization as a whole in terms of your own business. There's a lot of questions that people ask most of the time when we have discussions where people say, okay, are we really impacting how the business perform as the HR practices? And there's not been substantive evidence besides that which we find in the research. There are certain areas that we know, for example, bring more value to the business from an HR point of view. There are others that we know do not bring such much value. The worrying part is that people still continue to engage in those areas where there is not much value that is being generated in those areas. But despite all of us understanding that there's very little value. But with people analytics or workforce analytics, the advantage now is that we are now creeping into your own data within your organization, using the same methodologies that others are using to get into your own data and say, does this work for us or it doesn't work? Does this impact our business or not in an organization? For example, I was looking at if you can meet yourself, logical, if you can make sure that people are meted. Okay. So when you look at the impact, you need to make sure that is done properly. That's why we are coming up with this particular session to make sure that you understand how you can check for that impact. I was looking at one area, for example, through research where we are looking at wellness programs. A number of organizations have gone into wellness programs, but how effective are they? Do they impact the business? All that information is available through research. You can actually find that information available. Performance management, what is the impact? HR policies, what is the impact? Training, what is the impact? And is the impact big enough to warrant some of the investment that we then put in some of these issues? That's the whole purpose why we are having this kind of interest, and we are interested in making sure that we do all this in the people analytics field. So it's important to get this upfront. So in most cases, it's actually hard to tell if what you are doing in HR is helping the business to win. In the majority of cases, we're doing it simply because others are doing it. But when you look at it, you may find that there's actually no value in some of the things that we do. And for me, that's very worrying. That's why the field of analytics is coming in to help us to be able to validate whether what we are doing as organizations is actually adding value to the organization. Then it's also important to know that do we have the mechanisms in our own organization to be able to assess whether HR interventions are impacting the business? Sometimes people lack the right tools to be able to do that. And we hope that through this particular session, you will be able to then address that kind of scenario where, if I use these tools, I will be able to check whether what we are doing is adding value. Briefly, I just want to talk about evidence-based HR or management. You would know that there's a movement that is funded by people like Professor Robbie Briner, who are working on issues to do with evidence-based HR, and they've created actually a full website on evidence-based management, and I would urge you to go and read that. What they are driving at is that when you are making HR decisions, when you are making business decisions, use their best available evidence. In the majority of cases, they've discovered that people are just using their gut feeling. They rely, yes, on their experience, but the question is, experience are circumstantial in the sense that what worked before may not actually work now. And in your case, you need to be able to look at this and say, if we were to look at this issue, do we base it on our previous experience with the same issue, or we base it on fresh evidence? So evidence-based decisions making is central premise to analytics. Decisions should be based on best available evidence, as you see. So when you look at evidence, we're looking at information, facts, and data supporting or contradicting any claim or assumption or hypothesis that we may have as an organization. For example, I was looking at research about CEO pay globally. What we found is that roughly about 40% of the CEO's pay is actually determined by the size of the organization alone. And we went on to look at, so what about the performance of the CEO? We then found that the performance of the CEO only contributed about 5% to the variation in pay. So when people say we pay for performance, when only 5% of the CEO's pay is actually related to performance, you then start wondering, the rest is really about the size of the organization and other factors that have nothing to do with the performance of the organization. That's what we call evidence and facts. So whenever you make decisions in HR, you need to make sure that they are based on information which is current, they are based on facts or data, supporting or contradicting whatever hypothesis or assumption you would have made. That's important to take note of that. So that at least when you are doing such kind of making such kind of decisions, the quality of those decisions tend to go up significantly. Well, the moment you start looking at facts and figures, the quality of the decision that you make as the HR profession and as a business tend to go up, and the business benefits in the long run. So the outcome, the evidence can come from scientific research like the one that I shared with you. It can come from organizational facts. It can come from figures, benchmarking in some cases. It can come from what people are calling best practice or personal experience. But when you look at these sources of information, you notice that personal experience, best practice, benchmarking are not considered high-level quality data. What is considered high-level quality data is from scientific research. What does the research say? That's where you start. If you want to implement any program, what does the research say at the beginning? Do a slide that says, okay, we know we want to implement performance management. Does it affect performance? What does the research say? You are sharing this with your management team. Go and look at the best scientific research. If you are doing research based on journals, it's always to look at the quality of the research that was done. I urge you to rely more on what is called meta-analytic studies, which is a collection of studies that has already been done. Instead of you summarizing that collection of research, it's already collected for you. So what you do now is to just go and look at what are the findings. In some cases, they've looked at 500 studies on performance management, and then they came up with what are common findings, which could be 4 or 5. That's the cream that we're looking at. The quality of that kind of research is good. The second aspect of the research is that you may also want to look at what we call experiments. Experiments tend to give the best kind of evidence, or field studies tend to give the best kind of evidence. You can look at all this. There is a starting point. It doesn't necessarily mean we're discarding the issue of best practice or benchmarking. You don't want to implement something, you go and benchmark with others who have implemented. What was the situation before? What was the situation after? What was the side effects? What were the positive effects? You document that. So as you're implementing in your case, you can also be able to assess the impact of whatever you're implementing. Okay, majority of the cases you find that once you get to that stage, you find all your managers are all basing their decisions on evidence. But many managers pay little or no attention to quality of evidence. But I want to see the reason why we are preaching you HR analytics is that We want you to be able to preach this evidence-based movement to your own team, team in your own organization, to say, let's base our decisions on evidence. Most of the time, we go into meetings, we find meetings decisions are made based on someone's own opinion, with no facts at all, no sources of data that has been used. And people worship that kind of decision. And eventually, the decision turns out sometimes to be wrong. It's not always that the decision will be wrong. In some cases, it can be okay, but it could just be by chance alone, not necessarily because there's supporting evidence to that decision. And in most cases, you will find that people will tell you, no, I've been here I've been in this game for a long time. 20 years is a long time, so I know what I'm doing. All this is what we call them barriers to evidence-based management. Let's look at fresh facts. What are the facts saying when we are looking at performance within the organization? It's important for us to be able to do that. Okay, so that's important to do that. Let me just one stop. I just want to make sure that one of my colleagues is a co-host so that he can then allow people to go into the meeting. Okay, let's proceed. Thank you for that, Greg. So the evidence, I think we have already talked about where it's coming from. And the movement around the issue of evidence-based management is also strictly against the issue of following fads. Okay, I'm sure you remember Six Sigma, Lean, and Lean systems, and many other fads. And HR is probably one of the top professions where people follow these fads without necessarily subjecting whatever they're doing to evidence. And it's an issue for concern. So before you rush to implement anything that is you find people are popularizing, especially consultants, you must be able to see whether there's value or not. Because there's a lot of information flowing around and lots of big terms that are being used, talent and all these other big terms that people are using in order to sound very good and learned. But in actual fact, when you then look at it, you find that there's not much value that is derived from such kind of situations. So it's important as you're doing evidence-based management to then look at what are the critical questions. Evidence-based management applies critical thinking. You don't take things at face value. It applies logical reasoning in coming up with decisions and getting to any conclusion. So it's important to ask questions, okay? So if, for example, I normally hear people saying morale in the business is low because people are being paid, underpaid. Or many of such kind of claims, I would urge you not to be extremely careful, because before you make such generalized statements, you must have the evidence and the facts to support whatever you're doing. And also remember, even when you weigh in such case where you run correlations, you must be very careful that the correlation does not necessarily mean causation. It could be just those things are related in some way or the other, but it doesn't necessarily mean it's causing the one is causing the other. And it's very important to be able to do that. Just as an example, from research, for example, I know a lot of people say, no, business is low, we are not delivering because people are underpaid and things like that. There is actually no evidence that shows that if you pay people a certain amount of money, performance will improve. In actual fact, the relationship between performance and pay is very weak in most cases. So if you are going to go to your business and say, I'm not saying don't pay people, but if you're going to go to your board and say, let's double the people's salary so that we can perform, you are going to be disappointed because performance may actually not improve at all. It may actually even go down. That's what the research says. So don't make generalized statements if you want to go evidence-based approach. You don't make generalized statements. And what we always encourage in analytics is that you must always look at the before and after situation. This is what we did. This was the situation before we came in as HR to introduce a particular intervention. This is the outcome, the business outcome that is coming out. So you look at business outcomes before the intervention and after the intervention. For example, your company is not implementing a performance management system now, and you now want to implement a performance management system for your company. What is the current situation in terms of business? Are we performing? If we're not performing, which areas are we not performing? Get the numbers. Okay, then you go in there and say, now I want to implement a clear and structured performance management system covering everyone within the business. You run for the next 4 months implementing that project. Once that project is up and running, you start tracking the same indicators that you tracked before the implementation of performance management. Are they going up or down? And you also must get to a stage where you say, if they're going up or down, is it because of the performance management system? You must be able to, if the data is enough, you must be able to isolate whether it's caused by the data or not. Okay, so it's important to identify the problem. What is the problem? What is the evidence? And you revise the problem definition if it means it's not very clear in your organization. For those that like reading, I would like you to read this book called Fooled by Randomness, The Hidden Role of Chance in Life and in the Markets. What that book is saying is there's a lot of things that we are attributing causation to certain factors when they're just happening, not because there's anything causing them. They're just happening. And we tend to rush to say, people, as an example, one of the cases that I normally hear is that people are resigning because we're underpaid. And in one case, in an organization, they did a study and found that it was actually not, people were not leaving because of underpayment. They were actually leaving because of other reasons. So you don't rush without evidence to make such kind of conclusions. Always ask yourself, before you make a conclusion, do I have the evidence to support it? How credible is the evidence that I have? Depending on the priority of those decisions. If the decision is about where to eat, you don't necessarily have to use evidence. But if the decision is going to be a big investment for the organization, a performance management system, a change in the recruitment system, investment in training, investment in performance management, investment in a wellness program, you need to have your facts right before and after. So the mantra that we want to talk about is that let's always assess the before and after situation in all our cases. Okay. So what can you do with the data that you already have in your organization? Let's look at an example here where we are looking at a situation where an organization is comparing employee engagement and customer satisfaction. You can see there seems to be, this is not complicated stuff. It's not even a correlation at this stage. It's just looking at the trend of employee engagement over the month. This is where an organization has got an automated system where they collect employee engagement data every month and also customer data every month. So they're just doing a comparison side by side. You can see there seems to be a relationship. So if you run a correlation, you find that probably there is a very high correlation between employee engagement and customer satisfaction index, which is already also established through research that there is actually a correlation between the two of them. So that's the kind of stuff that we want you to start talking about in your business. To say, before you go to your board, before you go to your exco, you need to make sure that you've got the facts. What is it that you are seeing from the data, HR data, that can actually influence the performance of the business? Let's look at the impact of training here. Assessing the impact of training after training, a randomly selected group from a group of sales staff. You want to train your sales staff, you randomly select out of 20, you say select 10 to go for training, and the other 10 don't go for training. And you can see these are the sales numbers that are being brought in. For example, if you're in banking, you can do that with your business development staff. If you're in insurance, you can do that. If you're in any business that sells, that has got a large number of salespeople that sell a product, you can do the same. So when you look at this, you can see here that the sales team being not trained, the sales have not significantly increased. They seem to be maintaining a flat line. Then you can see for the team A that was trained, you can see the sales are going up. Okay, this is at face value. You can already visually, because you also want to overwhelm your board or your team with the correlation, regression, if they are not ready for that. But you can visualize that. So when you visualize that, even if you were to share this within your expo, they can clearly see that the training has an impact. But if you want to go a step further, you can then do what is called the T-test, where you're actually looking at the data and say, was there any significant difference in sales between the two groups that we are looking at? And most likely the results will show that there is a statistical significant difference between the two groups of sales team A and sales team B. That's what we want you to be able to do when you're doing your basic analytics. Then there's a case which is probably very rampant in many organizations. People hire people and they don't look whether the hiring is actually impacting the business. And in that case, you do what is called headcount analysis. I will show you a more detailed one later on where you're looking at headcount analysis. As you can see from this graph, the headcount is the blue one, the blue graphs. You can see the headcount is almost linearly growing up every period. But the sales, while they peaked in one area, they're actually going down as the headcount is increasing. And if people then come to you as HR and say, we will need to hire more people, what are you saying? If you don't have data, you end up with this kind of situation because the headcount that you are adding is actually not adding value to the output of the business. Here we've just looked at the sales volume, not necessarily other indicators. But if I were doing it in detail for the organization, I'll then look at 4 or 5 indicators and then correlate that to the overall headcount. If I can't correlate that to the overall headcount, I'll then correlate that to specific departmental indicators that we have, as I will show you later. Then after this one shows a company after introducing the wellness program, you can see from January, the absenteeism was very high. These are days. You can see 954 at the peak. Then in April, that's when they introduced the wellness program, April, May. And you can see by May, the absenteeism, unplanned absenteeism, it dropped from 954 to 235. That's a huge jump. And now, as you go into October, it's now at 22. And no one will begrudge you for being a genius for doing that, because this particular wellness program has a big impact on the absenteeism. Absenteeism costs you money. You are paying people when they are not being productive. So that's a good intervention from an HR point of view. That's where you start your analytics. It's not complicated stuff. You are already starting your analytics. You are just saying to yourself, when I look at the data that we have in HR, can I be able to predict business outcomes using that data? But remember, HR from a cost point of view is the staff cost are one of the biggest chunk of cost in any organization. In some businesses, to as high as 70%, especially those that rely more on people, to as low as 3% in some that rely on technology and others. So when you look at that, you will notice that that is a big issue that you can see there in terms of intervention. So you've actually shown at this stage, you're at a very basic level. You're just visualizing. You're not being complicated. You're not being mathematical. You don't need someone from analytics to be able to do that. You can do this on your own with basic mathematics. With Excel, all this was done in Excel. So that's the basic, the introduction. But if you want to go deeper, you can then go deeper. Then here we also have a situation where a company looked at their salaries. Because people will be arguing, oh no, if we pay this much money, people are living because of money. Yes, in this particular case, when they started paying, turnover went down significantly in line with the increase. The comparison is basically comparing your salaries versus the market. So when a comparison is close to 100, you are competitive. When a comparison is above 100, you are very competitive. So as the salaries are getting competitive, you see the turnover of staff is also slightly going down, although not in huge numbers, but it's also going down. Okay. Again, a very simple analysis that you can see. If you want, you can actually then break it down and say, where is this turnover coming from? If I do it by gender, do we still get the same kind of graph? If I do it by age group, do I still get the same kind of graph? If I do it by experience, do I see the same kind of graph? You may then find that for certain categories, the issue of money or being competitive in terms of salary does not affect turnover at all. And this can be easily done in Excel. You can actually do this in Excel. Let's look at a bit detail. If you then want to go deeper, you can go into deeper in terms of what is called headcount analysis. One of the biggest challenges organizations face every day is the issue of over or understaffing. How do you know if you're over or understaffed? The best way is to do what is called the headcount analysis. Okay, in the headcount analysis, you're basically using a scientific approach to analyzing your headcount. Okay, and in analyzing the headcount, you're using what is called headcount drivers. In every role or department, they are what you are calling headcount drivers. Let me give you an example. If you are running a bricklaying cooperative, and you've got 10 people and they're producing 10,000 bricks per day with whatever machinery you have, okay? And the market is growing. When you run every day, when you do your analysis, you then find, okay, there's a very high correlation between the number of people that are employed in the bricklaying and the actual output that we produce. In order to satisfy your market, it will be better than to hire more people. You run your analysis, your correlation, you find, there's a very high correlation between the two. Well, what it means is that if you hire more people, you're going to produce more output, and I would advise anyone to do that. But if you find then there is no correlation between like what we saw in the sales volume versus headcount, there's hiring more people will just eat into your cost and make you unprofitable. So it won't actually add much value to your business. That's the challenge that is there. So in headcount analysis, we go into each department and say overall as a department, what are the headcount drivers in this organization? If it's HR, it could be the number of disciplinary cases being handled, the number of recruitment being handled, the number of files being filed, whatever you produce or activity you engage in HR has got an output. We look at the output over a period of time and document that. Then we relate that to the number of people in each role. That's what we call headcount analysis. This is the example that I was giving you. For example, you may look at the number of transactions. If you're hiring tellers, the number of customers being served. If you're hiring TO operators, the volume of customers coming into the shop, it will determine the number of TO operators that you require. So, okay. And also there are temporary fluctuations in the volume of work in every role. So when you are running correlations, you take care of those temporary fluctuations because you're smoothing the curve when you're running the correlation. So it's important. Okay, if you go into finance, the number of transactions, total revenue, number of clients being served, all these are what we call headcount drivers. You can't run a headcount analysis without knowing the headcount drivers. Headcount drivers are the outputs that people are producing, that output of value to the organization or department. That's what we use then to calculate how many people are required. So the tricks that you can use if you want to go a step further than what I showed you in the first graph, you then go to your regression analysis. Regression is basically a more superior correlation. That's what they're saying. Because it's more predictive. You can then say, if I put 5 people, how much output will I get? Okay. Then if I put so many people, how much? So if you look at this graph that you're seeing, it's actually showing a regression where there's a straight line. So if it's output, you can then just cross and say, if I hire 20 people, I'll produce so much. If I hire 30 people, I'll produce so much. That's the whole purpose of the regression. And it gives you what is called an R squared or a regression equation. You use that regression equation then to calculate how many people you require at a particular output, the target output. You can also do trend analysis, which is basically the regression. Delphi technique, you can also use experts. In some cases, you can actually use the expert to say, based on your experience, how many people do we need for us to produce this kind of output? And remember, it again depends on other factors, whether you are mechanized or automated, and all those factors. These are factors that you need to take into consideration. But your forecasting using regression tend to take that into consideration, because it can then give you optimum number of staff that you require. A very simple analysis. If you were to go and run this in your own organization, you may find you're actually overstaffed in some departments and understaffed. So the example of an output that we did for an organization, a comparison of optimal staff. So you can see in these are departments. From department A, you can see that there is current number of employees. Okay, then you can see, for example, let's look at department C. The current number of employees is 17. Predicted using regression is 22, which means it's understaffed by 5 people. Okay, current predicted 77. Is the difference between the current predicted significant? Significant is it not just a random difference or a chance factor? When it's significant, that's when you act. When it's not significant enough, you don't need to worry about that. You may need to investigate further and say, do we really need people? The moment this relationship is not significant, you may need to then run and see, do we really need these people in the department? So you can also do an analysis in the same analysis using job families, for example, managerial staff. It has got proportion of current 2017, the proportion of predicted. It tells you the predicted, the cumulative percentage current, the cumulative percentage of total. You can look at that. It's actually a replication of this previous slide, but put differently in the form of job families. So for every role that you have in your organization, you can actually predict how many people you require at any given time using a simple regression. You can actually do that prediction. The next form of analysis that we would encourage you to do is what is called workload analysis. When you look at workload analysis, you are looking at a number of approaches that are there. There is what is called the NASA workload analysis tool. This one is not physical workload where you're actually going to count, because if it's physical workload, what we're doing now, this one, the headcount analysis, should be able to pick that. So the physical, as in counting and physical output and output that they are producing, use the headcount analysis instead of using what is called the workload analysis. NASA, which is not NASA or local NASA, NASA from America, they got a tool that they call a NASA workload analysis tool. You can Google that, it's available. But this one is more focused on what is called mental workload, which is the average of how much mental activity is required for each job. Physical demand, you're asking the person in terms of how they're feeling. Average on how much physical activity was required. Temporal demand, how much temperature does this particular task bring? Performance on average, also, so do you think you were in accomplishing the task? Effort, how hard was it to accomplish the task? We also measure frustration level, average of how insecure, discouraged, irritated, stressed, annoyed did you feel during the task, then overall workload. So all these are analyzed, and you do this by department. You can then go and say, when you look at department A, what is the overall workload, mental workload, okay, physical workload, okay? All these are the effort, performance, and overall workload. You can see the numbers there. Normally, what we'll do is that where there is a problem, we then put we then color code it in red, and it's very easy to administer. What we normally do is that when we are doing the workload analysis of this nature, we do a head count, we put it aside, same project, then you do your workload, we put it aside so that you can put the results side by side. It normally tells you a story in terms of that. And we also find there's a very high correlation between workload analysis and what is called time utilization. Time utilization, its purpose is to be able to find out whether your people are spending their time doing what is required and adding value to the business. So in time workload analysis, people feel what is called an automated timesheet, where they were actually asking, for those that have been in consulting for big consulting firms, you know what I'm talking about. We in consulting, for example, every day, at the end of the day, we indicate, I was preparing a proposal for company X, it took me 2 hours. I was preparing a report for company B, it took me hours. I did training for 3 hours. All that time is captured every month. So we have it. We've got a system that we have that collects all that info for every consultant that is here. And most of the accounting firms do that. Okay? But what we then do is there are codes that will tell you, is this core or non-core activity? For example, if I'm asked to go and print something that has got nothing to do with the client, it's actually non-core activity for the consultant. Or if I'm asked to do something that has got nothing to do with what my job, it's non-core activity. Things like that. So non-core it's not core to what you are supposed to produce and output in that particular role. And the findings are very interesting when you look at the results. You can analyze by department, by job family, by branches. All this can be done. Surprisingly, for example, this is an example, typical example that we extracted from another organization. Non-core activity analysis, for example, department versus proportion of time spent on non-core activity. You can find, for example, 23% of the time spent in human resources in this particular organization is non-core, followed by internal audit 6.3. And you can also drill down to see which are these non-core activities. It will then allow you to restructure the work to make sure that you put more effort on the value-adding core activities of your organization. And on average, you can see all department 8.3. In some organizations, we actually find almost close to 30% of the departments are focusing on non-core, non-value-adding activities. It's because of the way the organization has been structured or the way the people are being supervised. All this can lead to such kind of scenario. And it's very important to, people would think you're a genius just by doing a few of these things, which are very simple. If you were to go to your board or your exco as an HR manager professional, after doing this study, and you say, you know what, on average, we are spending 30% of our time on non-core activities. Already, we are saying we are paying people to do things that do not add value to the output that we want, and definitely that will affect the profitability. Also, depending on which department, definitely that will affect the profitability of the organization. We also look at the amount of time that is spent by people after hours, was they capture all this time. So when you are running a project on time utilization, we run it for a month, collecting information. Everyone needs to input an automated timesheet, which is approved by the manager, by the way, which is approved by the manager to check that people have not exaggerated. So when you look at this output from this particular organization, you can see Legal and compliant, 24% of their time they do most of their work after hours. Why? Okay. Then information technology, 23.5%. Why? In one organization, what we then discovered is that the people who were doing work after hours were getting a Nando's. They were also getting a tax home. So instead of someone going home to cook and it's boring at home, so they would rather spend after hours. They claim I've got a lot of work to do. Then they don't do their work during normal working hours. You'll find when you go to the core, in terms of proportion of core activities versus non-core, you find they're spending most of their normal working hours on non-core activities. Then they spend more time on evaluating activities, but after hours, in order for them to be able to be paid their Nando's and also get a tax free transport home. So this is worrying where we are putting it in red. All this you can then use that to restructure your organization. Then the other part that we do in the analytics side, which is basically looking at data in HR, is to look at productivity. On this one, I will not go into it because it's a full module, full course on its own. We use what is called the profit-linked productivity analysis, where we are saying profit is productivity always compare 2 periods. If you are doing what is called total factor productivity, you're always comparing 2 periods. So if you compare Q1 versus Q2, in terms of profit difference, that difference, if it's 20 million a year, we want to know whether that 20 million came from productivity or price recovery. Productivity, are producing more with less resources. So it largely depends on your capacity utilization of the resources that we have, and also resource allocation. These are allocated for resources. Capacity utilization is always calculated on capital equipment. For example, if you've got offices, if you've got machinery, that's where we calculate capacity utilization. All the things that go to your, all the capital things that go to your balance sheet, we calculate the capacity utilization of those. You may find that they are underutilized, they will eat into productivity. On resource allocation, it will look at resource allocation around people, resource allocation around finances, resource allocation around raw materials, power, and many others. All this will be analyzed. Then price recovery is looking at whether the profit that you got was either a result of over-recovering price, which means you're overpricing your product, or under-recovery, which means you're underpricing your product, or just okay. All this will come out in your analysis. A typical analysis from a company that we did in the manufacturing sector, you can see there. In the mining sector, sorry, you can see the productivity analysis. What is called the profit variance is exactly this table that I'm showing, this green thing. It's a difference between 2 periods. It will be 2 years, 2022 versus 2023, or 2021 versus 2022, or a quarter, or half year versus another quarter, or a prior year. That is the difference. That's why we're talking about profit variance. That's the same profit there. So you can see, for example, materials, the profit variance was positive with the productivity contributing about 11,490, which is a 22% increase in productivity. Then capacity utilization is 0 there because it's not a capital equipment. Then resource allocation, you can see contributed 11,490. Then price recovery, you can see this company was under recovering price, leading to a profit variance of 4,000 there, which is very low. So they are basically subsidizing the consumer. That's what they are saying. What the results are saying. So you are producing something and you underprice it below the cost of manufacturing it. So you're underpricing. It's called price under recovery. And people that do that, normally they're taking money from that is supposed to go to the shareholder and giving it to consumers. That's what it's showing. And you can see this company, most of the time it's underpricing. It could be a result of how they structure their business. And it's not going to last very long, this business, if it continues like this. Okay? Then we go to capital, capacity utilization. You can see there the contribution in terms of profit variance, 20,000 with a 2-point productivity coming of 2.81. All the other ones, they're negative in terms of percentage productivity contribution there. That's what you see. You can also go a step further and graph it, but I will not go into the graph for now. I will go into labor and supplies, detailed analysis. You're now looking at laboratory, repair. You can basically look at every item and look at its contribution to the business. And you will be able to restructure your business once you know where are we losing money. This tells you where are we losing money. Okay, you can see the input, geology, laboratory. These are people now, labor. You can see mining, negative profit variance, which means they're under recovering their price on mining. and engineering, they're under-recovering. Finance, they're under-recovering. Marketing, they're under-recovering. Only the smelter is actually giving us positive productivity. There is significant positive productivity because they are very productive. They're actually price over-recovering in terms of price recovery there with a contribution of 2.81. Marketing productivity losses of 14.33%. That's huge. When you compare to laboratory, that is giving you a positive of 13.09. Again, you can use this structure. Do we have the right people in marketing with the right competencies? Why is that we are productivity is very low? It could be they don't have the tools, many other things. It will take you further in terms of your investigation. But I like this kind of thing. I don't think there is anything, even financial people, they don't go into this detail. There are other models that you can use, but they won't go into that kind of detail. That's the detail that you produce. The report will be so detailed with the interpretation of each resource, its implication in terms of your business and where it's going. Okay, lastly, let's look at some of the case studies that we've done in the field of analytics. We did a drive assessment for a security company, for example, and we found that 26% of the accidents involved personnel that were between the age of 31 and 35 years old. And that was the trend throughout. That's what we found. That 26% of the accidents were, you're adding value once you start doing that. Okay, you're adding value once you start doing that. Then another analysis that was done by a colleague showed that women cashed significantly more money per day holding all other factors. Of course, then, if you got women conductors, either for your minibus or your buses, you find that they tend to cash more. We don't know what the reason is. It was a preliminary study that we did based on the data that was there, per bus and shift and everything. It showed that women were cashing more than the men. Then a study of retail shop branches with merchandisers, we found that branches that had merchandiser significantly sold more merchandise than branches without merchandisers. Okay, the reasoning, we don't know, but at first value, the reasoning could be when a merchandiser is there, the customers can ask questions. The merchandiser can interact with the customers and encourage them to buy. That's why probably they were selling more consistently in all the branches. All the branches that the merchandisers tend to sell more. And in one of our clients, when we were doing one of the projects, they were actually at the stage where they were getting rid of the merchandise because they were subcontracted. Said we don't need them, the extra cost. When we then showed them this result, they changed their mind. And after that, when discussing with them, they actually indicated that it was actually, our research was actually right. Okay. Then we also found that having a supervisor in charge of a chain of branches had no significant impact on performance of store branches. So this particular client had grouped their branches into zones where they've got a supervisor looking after each zone. So when you then look at the impact of the supervisor in terms of sales and the volume of sales and everything, they mentioned that the supervisor had no impact. In actual fact, after this analysis, we then went back to ask the people that were in the shops why the supervisor was not contributing significantly to perform the business. They actually gave a same reason throughout, that they were actually a distraction to what we want to do. They come and take our time by having meetings, useless meetings with us, instead of us going into the shop and try to sell the product. And this company ended up getting rid of those supervisors because they were not adding value by zone. The other one that we did was the TO operator one, where we found that the best TO operators in the organization that we studied, it is a significant amount of level of cognitive ability. They were doing more items per minute, serving more customers per minute. We also found that the best TO operators were not extroverted. Well, those that were extroverted were selling more, were churning out less items per minute, and also less customers per minute. So yeah, so these are some of, we just picked, because it's an introduction, just picked some of the highlights in the projects. But after this introduction, we will then go and say, how do we do a detailed headcount analysis? How do we do a detailed productivity analysis? How do we do a detailed workload analysis? How do we do a detailed time utilization analysis? These ones are coming in the coming weeks. This was just an introduction on workforce analytics. Thank you. So I will take questions. If people have got any questions that they may want to ask, I will be sharing questions. Okay, so if there are any questions, please let's start the discussion. Any questions? Okay.
There's some questions in the chat.
Oh, okay. Let me go to the chat. Correlation is correlation does not imply causation. However, but where there is no correlation between key variables, does that same principle apply? No. The first issue is you must establish a correlation, and it must be significant. That is, there can be a correlation, but the correlation could be insignificant. So when we say a correlation is insignificant, is you can find a correlation of 0.9, which is 90% correlation, but with no, which is a random chance kind of correlation, which means it's statistically insignificant, which means it can happen today and it not happen today. What that means in statistical terms is that if the correlation is 90%, 0.9, it means if you were to repeat the same analysis elsewhere, 9 out of 10 times it would be correct. Okay, if it's significant. If it's not significant, it's just chance alone. Okay, so it's not significant. So if the correlation is not significant, don't bother. Okay, even if it's high, don't bother. But there are other reasons why a correlation may not be significant. If you're using a small sample, maybe 10 people, it may not be significant because of the small sample. If you're using SPSS, you can go to a function called bootstrapping. You can bootstrap and say, I want to replicate this on a. If I was using a sample of 1,000 participants, for example, or 1,000 variables, you can then run a bootstrapping. If you find that it's not significant, it means it's not an issue of the sample. It's actually not significant. I'm now having challenges in understanding HRMS now from the way you have explained evidence management in relation to workforce analysis. Kindly assist. Metrics on their own without insights, they are useless, basically. For example, someone goes and reports that our staff turnover is 3%, which is 1 percentage points above last year. It means nothing. Okay, you need to go deeper into that. What is causing? What are the causes of that staff turnover? Is it by gender? Is it by age? Is it by profession? Is it by department? And if we find by department, is it related to any outcomes of the business? Should the business worry? Those are the kind of questions you ask. Most of the general reports that we see, I would say we call them good to know. We call them for your information kind of reports. That's why you find when you report in that kind of format, your HR committee doesn't even look at them. They don't comment. They just move on if you report in that kind of fashion. But the moment you start reporting using evidence-based management and detail, you then realize that they start asking you questions. And you must know that it's now making an impact. But if you look at most of the reports, they're generic reports that just report numbers. Numbers on their own means nothing. And most of the metrics are being reported just as numbers. How can I access the recording? We'll share the recording later on today, the link to the recording. Is there a local site that looks at how employee engagement is affecting performance? We haven't done the local one where employee engagement is affecting performance. We did one. The relationship was not that good for a retail outlet, for a retail organization. But we also found, because we did employee engagement by branch, in terms of business outputs, it had a relationship with customer satisfaction index. It had a relationship with the returns that the customers were bringing. Those are the ones that we found. With the rest, there was no correlation, significant correlation. But we also were of the view that it could have been the issue of the sample or how the organization was calculating employee engagement, because some of the employee engagement instruments being used are not reliable. So if you use an unreliable instrument, don't expect to find any relationship. But if there are organizations that have got data and they would want us to do a study, they've got their own employee engagement and other performance indicators that are common across organizations, we would run the same study. Can we say exit interviews add value to the metrics? Exit interviews, the majority of them are unreliable because they are not structured, they're not done properly. And the way they're structured is that people tell you what you want to hear. Even if you Google now, just Google exit interviews effective, then you say dash meta-analysis, you get 1 or 2 to 3 studies that show you most of them are actually useless if they are not structured. That's what we have been found. I actually posted a few of the studies on Twitter a few days ago on the exit interviews. Okay. Anyone else who may be interested in contributing? Okay, if there are no questions, thank you so much. We will share the link to the recording. Maybe after the recording, you can then have more questions. This was an introductory portion. That's why you will find that I was doing a few slides per section. But when we now go into detail on the other ones, we'll share with you. We're doing that in the next 3 weeks. Each week, we're going to do 1 or 2. Going into detail, for example, on headcount analysis, we're actually going to go into detail. How do you do headcount analysis? There's one hand up. Okay. Who is this one?
Yeah.
Yes, Alex.
Yeah, it's Alex. It's Alex. Thank you so much for with HR matrices and analytics. It's an area that has not been explored possibly locally. So yeah, we intend to. We feel we're going to get value, out of this, and possibly as the assimilation gets into this country. Yeah. Thank you so much. Thank you so much for the presentation.
Okay, thank you. Any other comments? Okay, if there are no comments, thank you so much. Enjoy the rest of the day. We'll share the link of the presentation, the recording, before the end of the day. Thank you.